For decades, real estate investors have looked at a 4% cap rate on multi-residential buildings and seen safety. But that number relies on a major assumption that mid-century concrete buildings running on fossil fuel boilers can continue operating exactly as they always have, indefinitely, without any major structural intervention. The law is already proving that assumption wrong. Vancouver has actively imposed hard carbon pollution limits on commercial buildings, with heavy penalties for non-compliance. Toronto is following suit. Through its Transform Toronto strategy, the city is developing mandatory building emissions performance standards that will legally enforce strict carbon limits. This chart compares a standard building's massive carbon output against the coming cost of compliance. To hit its net zero targets, Toronto faces an estimated $240 billion aggregate retrofit mandate. For older stock, that means $50,000 to $150,000 in mandatory capital expenditure for every single unit. When a 200-unit tower needs tens of millions of dollars just to legally operate, the 4% yield is an illusion. The underlying property is effectively a stranded asset hiding an 8-figure compliance debt. Traditional real estate investment trusts face a slow bleed. To stay legal, they must increasingly funnel investor distributions into massive retrofit capital expenditures. As these compliance costs trigger a market repricing, institutional capital will refuse to acquire non-compliant properties. They will demand assets that possess absolute regulatory immunity from day one. Vulpin Capital LP1 was engineered entirely to replace this fragile conventional model. They build using a highly efficient structural system called the industrial chassis. A completed Vulpin flagship produces an incredibly low 15 kilograms of carbon per person per year. They are not acquiring legacy real estate to fix it later. They're deploying the exact physical standard that the rest of the market will soon be forced to spend billions trying to catch up to. Conventional real estate funds carry heavy administrative bloat, high overhead, and blind pool structures that drag down returns. This diagram illustrates a leaner approach. Investors subscribe one time into the master LP1, which then allocates that capital directly into individually ring-fenced child property LPs, one for each building. This exact tiered flow-through structure isolates the liabilities of each property. More importantly, it ensures the capital cost allowance, the Canadian tax depreciation on the building, flows up through the master LP and directly to the investor on a single tax slip. This graph tracks the difference that depreciation makes. Because excess capital cost allowance can shield other holding company income, the investor's tax-adjusted economic yield climbs well past 4% over a 10-year timeline, leaving a stagnant 2.94% conventional after-tax yield far behind. Eliminating structural bloat delivers raw, customizable tax efficiency directly into the partner's hands. Traditional private equity charges a 2% management fee and 20% of the profits, slowly bleeding capital over the life of a fund. Vulpin charges 0 management fees. They also use a pari passu, or equal-step, entry sequence. On new construction, the founders break ground by funding their 20% share of the fixed-price contract first, before a single dollar of investor capital is called. Once investor capital enters the partnership, it is immediately deployed to retire all CMHC government debt on flagship acquisitions. Wiping out this government-backed debt removes rigid rent ceilings, unlocks short-term rental optionality, and clears the path for future condo conversions. True operational control and total asset security are only achieved when there are 0 external claims on the building. When a property is finally sold, the exit waterfall dictates how proceeds are distributed. The founder's ultimate compensation comes from a 35% promote, or bonus, on the exit surplus. But that promote is entirely subordinated. The founders earn exactly $0 until the investors have their full initial principal returned to them. To protect against emotional market timing or fire sales, the partnership relies on a concept called the hard deck. This diagram shows how the hard deck is calculated using split rebase math. The foundational land value grows at a historical rate of 7.2%, while the building value expands at 5.3%. This fuses together to form an ever-rising mathematical floor price. Exit timing is dictated entirely by objective mathematical reality and physics, completely insulated from forced fund calendars or market panic. The portfolio is built on 3 distinct asset lanes: The first two lanes, flagships and luxury new builds, are explicitly designed to be exited through sales and condo conversions, returning the investor's original capital. The third lane consists of purpose-built student housing properties situated near universities. The partnership will never sell these buildings. Once the flagships and new builds have successfully returned all initial principal, the investor enters the infinite horizon phase, left holding those perpetual cash flow student housing assets. At maturity, the portfolio generates growing, tax-efficient, perpetual income on exactly zero remaining capital at risk. Generational wealth requires regulatory immunity, aligned mathematics, and architecture built to outlast us.